Okay, good. So let's first get this optionistics view. So we have this one free website where we can get a lot of eyeball and eyeball data for individual US equity tickers. Okay, so you see here we have a fair bit of data, at least much more than 1 year. Okay, so you have the QQQ, okay, and the eyeball for the QQQ, okay, which you can see on your the ticker. What is the ticker? VXN. VXN is actually for the Nasdaq index, but since the triple Q tracks the Nasdaq index, effectively you can say the VXN is the eyeball plot for options on the triple Q. Okay, so in this recording, we want to understand what eyeball is and what H-ball is. Okay, all right. So first, what is eyeball? Let's try to understand what is eyeball. Let's first understand mechanically. Okay, and then we should understand eyeball at two levels. One is mechanical and one is intuitive. Intuitively, we have to understand, and interestingly enough, you won't find this intuitive definition of eyeball in any book. It's very difficult to find. Mechanical mechanical answer is available. Okay, so let's look at the mechanical answer first. What is eyeball? Let's look at a option price calculator. Okay, so the market will call this, the industry calls it an option pricing model, but actually we should call it an option valuation model. Okay, because it's a fair value model. You don't need a model to price it. Pricing is done in the market by interaction of demand and supply. Okay, so the terminology is not correct, but you have to get used to it because in industry people will call it an option pricing model. Okay, so here you have all these inputs and then you have these outputs. Really, you have a call option output, and this you should remember that the put option value is derived from this relationship. It's a no arbitrage relationship between call and put prices, so that's put call parity. So using that you derive the put option. Okay, so these are your outputs essentially, or let's say we have only one output, which is the call option. Okay, now so here are your inputs. Now you have all this. Now you find, let's say this is an OVM, okay, option valuation model. The output of this model is a fair value. Okay, what should be the fair value of the option price? So what this model is telling you is that these are the values of the inputs. Then according to this model, the fair value of the output is this. The fair value of the call option is $3 roughly. But if you look at the market, you find, let's say just for example, you find that the call option is trading at $5. So obviously this can easily happen, right? Where the market price is different from the fair value estimate, because the fair value estimate is just is based on a bunch of assumptions. Okay, and the most critical assumption here is the assumption about the vol. Okay, because these things there can't be any confusion about. Everyone knows what the underlying is. Everyone knows how many days to expiration. So the confusion is, the difference of opinion is only likely to arise from this. So we assume that the market, when it's arriving at that price of $5, okay, is also using this kind of an option valuation model. So therefore the only reason that the market's estimate of the price, which is $5, is different from your fair value estimate is because there are different assumptions about the vol input. Okay, so obviously your vol input was 25, it gave you a price of $3. Okay, and if the options price is $5, then do you think the option is using a higher vol input or a lower vol input?
So higher vol input.
Higher vol input. Okay, so they can be whatever using. So now the first question, the exercise now that we are going to do is, we observe that the market price is $5, and we, based on the inputs we entered into our fair value model, we find that output of fair value output is $3 roughly. So now we want to ask ourselves, now what should be the, and we know that the difference can only be due to differences in the vol estimate. Okay, so now what we want to ask ourselves is, what value should I enter for the vol estimate in order to give me a fair value output from the OVM which is exactly equal to the market price? This is clear. This is the exercise we are doing. Okay, now what you have to do is, you have to do, we've done this in the class, I'm pretty sure. I think I've done it in the class, but anyway, we'll do it again. So as you said, we obviously, if the market price of the call is $5 when the fair value is $3, that means the vol estimate of 25 in the fair value model needs to be increased. Okay, so let's randomly increase it to 35. Okay, see what happens. Oh, it's only $4, not good enough.
I can also apply scenario manager over here, like
you can use what?
Manager. like I'll in Excel, if I'll be putting that value to $5,
Yeah.
so like by changing the volatility, it will come. The amount of volatility will automatically be taken.
No, no. Are you one? Let me just finish the calculation. Let me explain to you first. You have to understand what the certain aspects about the mechanical understanding of eyeball. If you're talking about scenario manager, I've not used that. I mean, are you talking about a display for different values of?
No, sir.
Okay, we'll talk about that later. We'll talk about. No need to worry about Excel at this point. Okay, let's just get the concepts right first. Okay, so I increased it to 45. Now that's too much. It's going above $5. Okay. So let's make it 42. Okay, it's a little closer. So maybe if I make it 43, it's closer. So maybe I should actually make it 42.5. Now it's much closer. So I should make it maybe 42.4. Now it's exactly 5. Okay. So if you saw the process that I went through, this is an iterative process, right? Okay, so the first thing you have to understand about eyeball and the mechanical aspects of eyeball is that you can't actually, just because, see, normally when we have a equation, x is equal to k plus l. If I write x is equal to k plus l, and then I ask you to say, then I ask you to tell me, okay, then what is l? So if x is equal to k plus l, that means l is equal to x minus k. Okay, so this is what is in mathematics is called an analytic. I've given you a very simple example, but this is called a analytic solution, where you just cross multiply, interchange the terms. Okay, then you get the solution. Okay, this is an analytic solution. Now what I did here is not like that, you notice.
Yes, sir.
Although I had a value of the output,
Yes.
okay, and I had a desired value of the output, should have been, I should set the output equal to 5.
Yes.
Then I should be able to solve for the input.
Yes.
But in the case of eyeball, you can't do that. You have to understand that this is not, eyeball is such a calculation where you cannot solve analytically for the correct value of eyeball, which will give the same input, same output from the OVM as the market price. Okay. Do you remember any other calculation from your corporate finance analysis, what you did in FM1 and FM2? Do you remember any other calculation which you have covered in finance which has this kind of characteristic, where there is no analytic solution? You calculated something which is such a thing that it cannot be calculated in an analytic way. Now you understand what is an analytic solution.
Yes.
Can you tell me what you have done, what else you've done where there is no analytic solution? You have to, the other way to solve in mathematics is what is called by iterative approximation. You saw what I did just now. I took 25, I increased to 35, not good enough, increased to 45, too much, brought it down to 42.3, then 42.2, so on and so forth, and finally I came to the solution. Trial and error. Okay, so can you tell me some other figure that you have calculated in finance which also has to be calculated by this iterative approximation method and cannot be calculated by analytics through an analytic solution? You remember? Is my question clear?
Yes, the question
Yeah.
is clear.
Yeah. What is it?
I don't exactly remember in finance, but I remember like in quant we have done something like that. Like
What?
Putting yeah,
Something else which you have calculated, which can only be calculated?
with the help of this trial and error.
Okay, so I'll give you the answer. The answer is IRR.
Okay, yes, sir.
IRR also, although you know the IRR equation, okay,
Yes, sir.
you put the, okay, you can just take it also as the bond YTM equation. As you know, bond YTM and project IRR are mathematically the same thing, okay. So IRR is also another thing, and therefore YTM also is another thing. So these are the two other items,
Yes.
bond YTM and bond project IRR, which are mathematically equivalent, okay. These two also cannot be calculated analytically,
Okay.
because everything else is known
Yes.
in project. I mean, it's not known, but projects, in a project you're estimating the cash flows.
Yes.
But once you have estimated the cash flows, you can you put it into the figure, your model. You put the estimate. The project cost is known,
Yes.
and you have made an estimate for the your cost of capital, etc. In this case, you have to look at the in this case the cost, the discount rate is what you're trying to find out. Okay, IRR. You cannot find it analytically.
Yes.
It has to be done by trial and error,
Yes.
iterative approximation. So mechanically, eyeball has this property. Okay, you cannot analytically solve for. But so we found that this is the eyeball. So what is the eyeball then? Therefore, this is why I said, this is why your notes, this part has this part. that it is, now you see what I've written here makes sense. I vol is that vol input in the OVM which makes the OVM throw out a fair value for the option that is exactly equal to the market price for the option. Is this clear? It's a long definition, but it has to be accurate. That's why it is long. Okay, is this clear? Okay, that's why I have said again, making you repeat that logic so that you know how to use the language properly. I vol is a species of vol input into an OVM. Okay, you saw that we were throwing in various vol inputs, and for each vol input the OVM was giving me an output. But those outputs were not equal to the market price. But those are still valid OVM outputs. Okay, so that's why I say that I vol is a species of vol input into an OVM. Remember, contract is a species of agreement. Okay, so all contracts are agreements, but all agreements are not contracts. Okay, so all I vols are vol inputs into a OVM, but all vol inputs into an OVM are not I vol. I vol is only that vol input which will give you an output equal to the market price. Is this clear? So this kind of conceptual understanding should be there of I vol. Then, intuitive answer of I vol. Okay, try to understand the intuitive meaning. So mechanically you have understood what I vol is. Now, and again, so understand this now, so we can just segue into the intuitive answer. Okay, now intuitively what are we saying? If we say that with these kinds of inputs, these are the outputs thrown out by the OVM. Here these are easy to understand. We are expecting a 1% dividend over this period. Okay. Now this 42.4, what does this really mean? It mean, and remember now that we have set the this vol input is actually the I vol itself. This vol input is the I vol itself. Okay, which means that if the market is using this kind of same option pricing model, okay, then the market's input for the vol in this OVM is 42.4, which means what the market is saying is that over this period, okay, we are expecting H vol equal to 42.4, okay, which means that the market is predicting that over the next 30 days, okay, the market price will move in such a way that if you step in a time machine and jump forward 30 days from today, okay, and then you look back at the previous 30 days of price action, which you have no idea about today. Okay, but if you get in a time machine, jump forward 30 days and then look back on the previous 30 days. In this case, 30 days is for 1 month, and we can let 20 trading days or whatever. Okay, let's assume that it's 30 days. So you look back, you will jump forward 30 days, then look back on the actual prices recorded over the next 30 days, over the previous 30 days. Okay, which is from today to the forward point where you jumped. Okay, and that period you will then do the H vol calculation, which is given in your Hull Basu book, which is the standard way of doing H vol calculation in your you see so if you see here, yeah, there is a calculation of H vol which is given here in page on page 353 of HP of Hull Basu. You can see that, but there is a standard way of calculating H vol. Okay, you first set up your data series, which is the price history as a time series. You take the second column will be the price relatives. Okay, that is PT plus 1 divided by PT. Okay, then in the third column you take the natural logarithms of the price series, so you get a natural logarithm series UI. Okay, then you take this, okay, then you follow these steps, okay, take the standard deviation, then multiply it by the square root of time, etc. Okay, they use these perform these calculations. Okay, now then you come to a vol estimate. Okay, so this vol estimate that you come to here, this is 19.3. okay, which as I explained to you is the one standard deviation price change that we are expecting, which means if the price today is say $100, then we are expecting roughly 119, that 2/3 of the time the price will remain 1 year. In 1 year from now the price will be between 119.3 and about $80, okay, $81, okay, on the downside. So 19%. So this is the 1S1, the H fall estimate is the one standard deviation price change, okay, and this is how the H fall is calculated, okay. So essentially, when you go back to this calculation of H fall, that means what the market is saying at this point when it puts in an IVOL figure of, when it gives you an IVOL of 42.4, that means the market is expecting this exactly. This is what intuitively it means, that it is the option market's estimate of the future value of H fall that will be recorded at the end of this period, whatever this period is, 30 day, 90 day, 100 day, whatever. Okay, so that is how it is. So we should write it down here that we have to go up a little bit. Okay, so what we should write down here is that IVOL is the option market's view on future readings of IVOL. Okay, that is example of a 30-day option. Okay, if IVOL is, we take the example that we gave, if IVOL is, if IVOL, these guys are making it close. Just is 42.4%. Okay, then option market thinks, okay, based on prices available in the option market. That's why we say the option market thinks. Now the option market could be wrong. Okay, the option market thinks that if you, let me just give you this crude explanation that I gave, but I think it gives you a picture of what is meant, what the option market is actually saying, that if you jump in a time machine, and if we write it like this, okay, let's make it a little bit more elegant. Okay, that if you took a H fall reading, okay, calculated as given below in HB, okay. So if you took a H fall reading, means you have to take the reading according to the method mentioned in Hull Basu down, further down in the notes, okay, the proper way of taking H fall calculations. If you took a H fall reading, 30 days of the example we have taken, 30 days from now, okay, that reading would be 42.4%, okay, and that, what is the meaning of H fall, that we have already given downstairs, I mean not downstairs but down below in the notes, okay, which is that it is the one standard deviation price change, okay, over based on historical data. Based on historical data, H fall is always based on historical data. It is the one standard deviation price change, okay, for annual for 1 year period, okay, which means that if you get a figure like 20%, that means on average you would expect on 2/3 of the time the price, whatever the price is $100, then 2/3 of the time, 1 year from now, the price should be trading between 120 and 80. That's what H fall means, okay, and therefore, and what the market is saying, what the option market is saying is, if the IVOL is 42.4, that means 30 days from now, if you took an H fall reading over 30 days of data, over the previous 30 days of data, then that also I should clarify, that if you took an H fall reading 30 days from now using 30 previous days of data, okay, that reading would be 42.4%, okay, for from the calculated from the same daily data figure, okay. So this is what it means, okay. So this is the market's forecast of future H fall, which can of course be wrong. This is clear. I shouldn't say it that way, which could be wrong or it could be right, but in general we do not have any a priori expectation that the market's forecast of future H fall will necessarily be correct.
Yes.
We should be skeptical that this is just the market's forecast, and we can test whether it turns out to be how right is it or how wrong is it, etc.
So then are we supposed to write the reason for differences as well?
1 minute. I think we can